What happens when a global car brand gets blindsided by a tariff war and squeezed out of its biggest markets? Volvo Cars just got its credit outlook slashed by S&P. It's cutting thousands of jobs, and some of its most iconic models are vanishing from the US lineup. Why? A perfect storm of 125% tariffs, brutal EV competition from China, and a crumbling global strategy. In this video, we'll unpack the big headlines, the hidden struggles, and what Volvo's next move could mean for the car industry. Can Volvo survive this global pressure? Hit the like and subscribe for updates, and let's dive into the details. S&P just delivered a gut punch to Volvo Cars, shifting its credit outlook from stable to negative. And they weren't vague about it. The downgrade stems from two looming threats: US import tariffs and suffocating competition in China, two of Volvo's biggest markets. The US accounted for 16% of Volvo's sales in 2024, while China made up 20%. Combined, that's over a third of its entire business at risk. Volvo's biggest vulnerability? It only builds one model in the US, making it far more exposed to tariffs than its European rivals who have deeper American footprints. S&P also cited fears around a proposed 2027 ban on automakers controlled by Chinese entities, a direct threat to Volvo's future in the US, given its Chinese ownership under Geely. The firm added that Volvo's ability to generate cash and maintain profitability through 2026 would come under intense pressure, only partially offset by cost-cutting. Put simply, S&P doesn't see a smooth ride ahead, and when investors get spooked, companies start slashing, which leads us to Volvo's drastic decision to withdraw its earnings guidance. April 29th was a brutal day for Volvo. Its shares dropped 10%, operating profit plunged 60%, and it yanked its earnings forecast for the next 2 years. The culprit? Trump's auto tariffs, now clocking in at 25% to 50%. With nearly 90% of Volvo's US sales coming from imported vehicles, the company is getting hit with a surcharge it can't absorb. So it's firing back with a plan to save nearly $1.9 billion, including job cuts and a total revamp of US operations. CEO Håkan Samuelsson, brought back to steer the ship, is ditching the globalized model. Instead, he's pushing Volvo to create more autonomous regions, tailoring cars for local markets like the US and China, rather than forcing global designs to fit every market. They're also calling on Geely for more cost synergies. Think shared suppliers and platforms? Volvo's strategy is shifting fast, but that doesn't mean the pain is over. Next up, even their US plant isn't safe from the fallout. Let's talk about South Carolina. Volvo's $1.2 billion Ridgeville plant in South Carolina, once seen as its lifeline in the US, just went dark. On May 30th, production halted due to a parts shortage triggered by, you guessed it, tariff-rattled supply chains. Although the company resumed assembly within 2 days, the disruption exposed how fragile even local manufacturing has become. The EX90, Volvo's flagship electric SUV assembled there, might be American-made on paper, but in reality it's a global jigsaw. 20 to 25% of parts come from the US or Canada, 30% from Mexico and China, and the transmission, made in Sweden. Even this American-assembled car gets walloped by tariffs. Volvo's trying to cushion the blow by planning new production lines at the plant, possibly for a hybrid SUV, but that's long-term. Right now, they've already laid off 5% of the factory's workforce and the EX90's sluggish US sales, just 4,051 units globally through April. Make that expansion harder to justify. Volvo isn't just trimming costs, it's slicing deep. In late May, the company announced it would slash 3,000 jobs globally, including about 15% of its white-collar workforce in Sweden. The move is part of its massive $1.9 billion action plan to stay afloat amid crumbling profits and trade volatility. What's more alarming, this comes on top of previously announced layoffs at its US plant, meaning Volvo's workforce is shrinking on both sides of the Atlantic. CEO Håkan Samuelsson framed the cuts as a survival move during a challenging period. EV subsidies are being clawed back, US tax credits are at risk, and raw material costs continue to climb. On top of that, the company just lost its US sedan lineup, the S60 and S90, due to a whopping 125% tariff on China-made cars. And in South Africa, 12 Volvo dealerships shut down in just 3 days, leaving employees blindsided. The company says it's consolidating for premium service, but the reality is that Volvo is downsizing fast and hard. Let's talk numbers. The 25% auto tariff on imported cars and 30% to 125% duties on foreign parts are reshaping the sticker prices of every Volvo on US lots. And yes, that includes cars built in America like the EX90, because they still use globally sourced components. The math is simple. More tariffs mean more expensive cars. The EX90 starts at $79,995, but that number could creep up fast as material costs climb. Even used vehicles, parts, and service fees are feeling the pinch. Consumers are already asking, should I buy now or wait it out? Dealerships like Win Volvo in Hampton are urging buyers to act fast before prices spike. They're also recommending shoppers stick with US-built models like the EX90 or plug-in hybrids to avoid the worst of the tariffs. But even that's a partial fix. And the pain isn't just at the cash register. Supply chain headaches, especially around rare earth magnets from China, could shut down vehicle production entirely. Automakers warn they might have to idle US factories within weeks if the shortage continues. So what's ahead for Volvo Cars after all the trouble? Volvo's future is still caught in a storm. Tariffs, layoffs, plant pauses, and evaporating sedan sales. But the company's leadership is pivoting fast. Their next move? Focusing on regional manufacturing, especially in the US, and prioritizing SUVs and hybrids that Americans actually want. The S90 and S60 are gone. The EX90 and upcoming hybrid SUVs will likely carry the brand forward. There are even whispers of building a new US-only model to keep the Ridgeville plant running at full tilt. With a capacity for 150,000 cars a year, Volvo can't afford to let that plant underperform. The wild card? Geopolitics. If the US and China can't resolve their differences on rare earth exports and auto tariffs, Volvo could see further production halts. Remember, China controls 90% of global rare earth processing, and licensing delays are already threatening US factories. On the competitive front, Volvo's dealing with more than just tariffs. It's in the crosshairs of BYD, which grew NEV sales by 41% in 2024 and just beat Tesla in Europe. Volvo is fighting a war on multiple fronts. Whether it survives or thrives depends on how fast it can rebuild for a regional, SUV-hungry, electrified world. The game has changed. It's now about who can shift direction quickly. And for Volvo, the clock is ticking. In the end, let's take a brief look at the details from today's video. S&P gave Volvo a lower credit rating. US taxes hurt earnings and stopped some models. Thousands of workers were let go globally. Its US factory stopped, then slowly restarted. Car prices are rising fast, even for US cars. And China? A very tough market with no kindness. Volvo is focusing on SUVs, making cars locally, and plug-in electrics to survive difficulties. Will it work? Can this brand compete in a world changing so quickly? Share your thoughts on this below in the comments, and don't forget to like the video and subscribe for updates. See you in the next video.